Hi, thank you so much for joining me today in the Smart Homebuyer Workshop. So, my name is Jonathan Sweat. I'm with the Legacy Team, Integrity Home Mortgage, and look forward to you being here and being able to answer any questions that you may have as we go through this. So, our workshop today we're going to cover some different things as it relates to, um, how it looks between renting and owning. We'll also take a look too at return on investment with buying real estate, what that looks like in today's market. We'll go through kind of the process for getting pre-approved and what to expect as you go through the process. So we'll cover a lot of different things in really 30 minutes, and my goal is to end this right at 1 o'clock. So we'll be out on time. Okay. So any questions that you may have as we go through, feel free to put it in the chat area on Zoom. And I'll make sure that before we finish things up, that I will address anything that maybe I did not cover as we go through it. But one of the questions I get asked all the time is, is there a big difference between renting a home and owning a home? And obviously, the answer is a big yes. The reason I get asked this a lot in today's market is because people have heard rates may be a little bit higher than where they were 2 or 3 years ago. So, would I not be better off to rent versus buy something or just wait and buy something in the future? And the answer is no, absolutely not. You need to buy now. And I'm going to get into more of that in just a little bit when we start talking about appreciation. But the values of homes are not coming down. So if you are on the fence right now about, should I keep renting or should I rent instead of buy? Here are some things to take into consideration. Number one is tax advantage. Of course, when you own a home, there's certainly none whatsoever. When you buy a home, you're not always going to get a tax advantage. It may depend on your specific tax situation, but there very well may be a tax deduction on the mortgage interest that you pay. Security. When you rent, you don't have any security over the property because it's not yours. When you own the home, obviously, it's yours to do with what you'd like to until you decide to sell the property at some point in the future. Inflation protection. This is the biggest thing that a lot of times my kids will look at when they see the home that we own and see what my mortgage payment is because my mortgage payment is incredibly low because we owned this home for 22 years. And it's all because of what we were able to buy the home for, of course, 22 years ago. And that has kept our mortgage payment very, very low. So, rent, if you are renting, if you're thinking about rent, something to consider is most years your rent will go up. And when you buy a home, your payment itself is locked in until you refinance it. And usually, if you're going to refinance, your payment's going to come down or your payment may potentially change if the property taxes go up or down, mainly up, or if your homeowner's insurance either adjust up or down. Those two things could cause your payment to change, but your actual principal and interest mortgage payment itself would not change. It's locked in. The other item is investment. When you're purchasing real estate, or let's back up, when you're renting real estate, of course, you have no money out there being invested. It's not invested, it's just helping your landlord become more rich and creating more wealth in their pocket, but it really does not do anything specifically for you. The when you own a home, obviously the value is going to go up. Again, I'm going to talk more about that in just a minute. But if you take a look at what will you pay in rent, like if you keep renting, and let's say your rent now is $1,000, and let's just assume it doesn't ever go up over 30 years, it never goes up, which we know is not going to be the case. But over 30 years, that's $360,000 that you've put into someone else's pocket. And here's some different numbers on the left-hand side in the column of whether you're paying 1,000, 1,500, 2,000. It adds up quickly into going into something that is not helping you build wealth. So it's one of those things that you really do have to take a look at, making sure that you're first concerned about your own wealth and not someone else's. But home ownership definitely, in my opinion, is the first step to creating wealth is owning a home. Now, here's why. When you own a home, and something, if you start talking about other types of investments, let's say mutual funds or stocks or your 401k plan, a popular term is ROI, which means return on investment. What type of return on investment are you getting when you buy real estate? So I'm just going to give you a quick example here of a purchase price, let's say $300,000, and if you did a 10% down payment. So if you did 10%, that's like investing in $30,000. But here's the cool thing. You're earning interest on the total value of your asset when it's real estate, not just the 30,000 that you've got. So normal appreciation right now, and when I say normal, it's not really what we've seen the last 2 or 3 years. It's been beyond normal, but normal appreciation in our market is about 5% a year. So if you think about this, like over the course, let's say 2 years down the road, your 5% appreciation is getting you back on that about $30,000. If you did a 10% down payment up front, you put $30,000 in, 2 years later, you're getting $30,000 return. That's 100% return on investment. Like there is literally no other possible thing you could invest in that's going to give you the return that real estate typically will give you year in and year out. So, yes, I know it's not like liquid money that you can take and put your hands on immediately, but you absolutely could sell your home and get that intangible money or use that to buy a larger home in a few years or maybe a second home somewhere. So it gives you a lot of opportunities and it changes your life forever. There was recently a statistic I read somewhere that said people that are retiring, they rely 70% on the equity of their real estate versus their 401k or their retirement plan. Again, most people that retire are relying about 70% on the equity they have in real estate versus their 401k. Like that's a staggering statistic. And the reason is due to the amount of equity, appreciation, and return on investment that real estate is going to offer you. So one of the most common things as we move on that it seems like if there is an elephant in the room right now with buying real estate, it is mortgage rates. And I have heard so many different stances on this. Like I've had a lot of people call me recently that I've done loans for over the last 2 or 3 years. I heard in the media or on the news that rates are lower. I want to take advantage of it. So here's the thing. Rates, number one, adjust literally every single day with whatever may be happening in the marketplace. Rates are constantly in flux and moving. Okay. And that being said, they may adjust during the course of a day. So they're always in a state of movement. Now, rates did have come down over the last month or two. That is a true statement. However, what a lot of people don't realize is it's only been about 2 to 3 months that rates were closing in on 8%. So when we say rates have come down, that is true. However, a lot of times people think when they hear rates have come down, they're thinking back like they were a few years ago when they were 3 to 4%. Some people were lucky enough to get in even under 3%. Rates are not there. They're not there now. Maybe in the future, they may be back in the fours. I don't know that we'll see anything under 3% again in my lifetime. That was very much an anomaly, very unusual. But some people do have rates at 2.5%, maybe even a little bit under that at some point. We're not at that level. Right now, rates are kind of in the mid sixes. Now, here's something else I want to put out there that a lot of people don't know about too when it comes to interest rates. And that is there are a few people right now, I think can get a mortgage rate under 6%. In fact, I've locked in a couple of clients over the last week or so at a rate closer to 5.5%. Why that rate is out there? Fannie Mae and Freddie Mac both have and offer incentives to people if they're, number one, a first-time home buyer, and if their total household income is underneath a certain limit. And if you're able to meet the criteria that Fannie Mae and Freddie Mac have for that, then yes, your rate may very well be in the fives right now. So that is out there, but it's not for everybody. And I try to stress with my clients to let them know there's actually 20 plus different factors that go into interest rates. Credit score is by far the biggest thing that determines what a person's rate may be, but other items are going to be the amount of money they're putting down. A lot of times, if you can make a higher down payment, say 25% or 30% down, you may find a better rate. Okay, so there's a lot of different factors that go into play in determining a person's rate. The other thing is too, I'll spend a little bit of time talking about, and that is it ever worth buying the interest rate down? And what does that mean? One common phrase or term, rather, used in our industry is points or discount points. So, what does that mean? Number one, a point. If you ever hear a lender talk about a point in closing costs, a point is equal to 1% of your loan amount. So, if you're looking at a $100,000 loan amount, 1 point would be $1,000. It's extra closing cost. So when you think about discount points and interest rates, I think it's a good analogy to kind of explain what it means. Is if you're in, let's say, Lowe's, and maybe you're looking at paint, you're going to paint your living room. There might be three different types of grade of paint. One would be best, that's going to last for many, many, many years. Another might be better, that's going to last for a few more or a few years, but not as good as the best. And then there's your cheap paint, which if you're looking at selling a house, maybe all you want to do is throw a fresh coat of paint up, and you know the new owner is probably going to repaint it to what they want. So you've got good paint, better paint, best paint. Well, the good paint's cheap. Better paint's going to be a little bit more pricier. The best paint's going to be the most expensive, but it's going to last you over the long term, right? So rates are very much kind of like that. A lot of times when I'm quoting someone a rate, I'm quoting them a rate to keep their closing cost at a minimum, which means I'm probably going to charge them or look at a higher type rate, but it keeps their closing costs down. Anyone, though, whether it's us or an online lender or any bank you're talking to, anybody has the ability to charge you additional closing costs or points and lower the interest rate. Okay. A lot of times that may not make sense in the case that you may be buying a home and maybe it's not your forever home, or you know your company is going to transfer you out of the area in a short period of time. Probably not, probably will not make sense to pay points because you will not be in the home long enough to recoup what it costs extra for what you're saving each month. Another item may be if rates are kind of on the higher side, which I would say even right now, even though they are lower, they are a little bit on the higher side of where we're probably going to see over the next 2 years. If you may not keep the loan for the next 2 to 3 years, it probably does not make sense to pay points and buy the rate down because you will not have the loan long enough to recoup what you're saving each month. So these are things to consider whenever you're looking at, whenever we're looking at rates, whenever we're looking at your closing costs. There's a lot of things that go into that. All lenders, honestly, most lenders are created somewhat equal. You're not going to find drastically different rates from lender to lender to lender. But what some online lenders do, and you have to be very careful, is they will quote a rate, but not tell you what's behind the rate. Again, most lenders can offer you lower rates too. There's just going to be closing costs. The closing costs go up. So everything is not just in the rate. And I just want to stress that piece to make sure that folks I talk to understand when they are looking at different lenders, it's not all about the rate. It's what's going into the closing cost piece. And you need to make sure you're being told the truth of, having someone look out for you of not just your short term of getting the lower rate, but also the long term of making it make sense that it does make sense to pay points and to get that rate down. Okay. So, anyways, these are things that we certainly go about talking to you through when you do have a ratified contract and make sure that you have all of your options with the money that you have to work with. Okay. So as far as the home loan process, and some of you may already be on this process with me right now, but step number one is pre-approval, and that is to determine how much you can afford before you go house hunting. Obviously, very important. Most realtors want to make sure that you have already done this step before they start showing you homes. So there is a difference between pre-approval and a pre-qualification. A pre-approval means that I've taken the time to look at your pay stubs, to look at your bank statements and your assets. It means that we've kind of already have underwritten your file to a certain extent up front. That's a pre-approval. It really makes your offer when you are ready to make an offer on a home, makes your offer stronger. So that is that piece. When you do have a ratified contract on a property, the next part is going to be a formal application. That application is actually specific to the home that you're buying. So I know it may seem in the beginning, well, I've already made application, right? But now we're going to do formal application, and formal means that we're doing it specifically to a property that it's tied to. Okay. And you typically on your contract, your agent is going to give you so many days. Normally, it's within 3 to 5 business days of making formal application with us. Once you do the application and you've signed everything, then we start processing your loan. That means that if we need to do an appraisal, we'll order the appraisal, we'll order the title work. We're going to kind of tidy up your loan and put it in a neat story to present to step number four, the underwriter, and make sure that we have presented to the underwriter every source of evidence that shows that you should get pre-approved, you should get approved for this loan. The underwriter will go through, verify all the documentation makes sense, verify that what we looked at on your income does have the correct number on your actual application. They'll go through, underwrite the file, then we get it cleared to close. Those are the 3 words every realtor, every client likes to hear is your loan is clear to close. Basically, that means there is nothing left to do for you except go to closing, sign a lot of paperwork at closing, but at closing, you get the keys. All right, so that's kind of the 5 steps of the loan process. And then these are things too we may have already discussed with you at some point, but these are typically the financial documents. If you've not already provided these things to us, things that we need in the loan. We like to see that the last 30 days you are employed or see what kind of income you're getting over the most recent 30-day period. W-2s. And then if you're self-employed, it could be another document called a 1099 and probably to your last 2 years of tax returns. If you get W-2 income, we typically don't need tax returns. So the tax return piece that you see there is really only for self-employed. And then if you get other types of income, say like Social Security, you're going to get a yearly Social Security awards letter that says how much you get each month. We would need that. If you receive retirement income, maybe a pension, any type of documentation you have on that that states what you receive monthly. And then if you get disability, there's a difference between permanent disability and then temporary. An underwriter is always going to want to make sure that if you're getting, any type of a disability income, or let's even say child support income, we have to document that it's going to continue for at least 3 years. Okay. If it's no guarantee that it will continue for 3 years, most likely we're not going to be able to count that income in your scenario. All right. And then bank statements are a common item. We want to make sure that you've got a bank account, that you've got a little bit of money to cover what may be needed at closing. Photo ID, typically your driver's license. And then if you happen to be in the military, a couple of things I want to mention on that while I'm thinking about it. But obviously, if you're in the military, certificate of eligibility, if we're looking at doing a VA loan, and whether you're doing a VA loan or not, one of the things that I'm proud to say we do on my team is we offer all veterans, um, previous or current or actively serving. We offer first responders, anyone in the healthcare field, education field. We have something we call Homes for Heroes, and we it's just our way of saying thank you very much for your service to our country. And we give you a $500 credit at closing that can be used toward closing costs, obviously, as long as you use my team in doing your closing. Okay, so that's kind of what you're looking at on that part. And, if we pre-approve, you typically a pre-approval to last for 4 months. However, if we pull your credit, let's say it's October, and then you decide it's in January that you find your home, we'll most likely need to get updated pay stubs. If it's February, we probably would need to get updated W-2s. Okay, so there's our things that at some point we might have to get updated along the way. But typically, once we have you pre-approved, we don't have to re-pull your credit again for 4 months. Okay, so anyways, that is how that works on that part. And it is just 22 minutes in. So I've got about 8 minutes to answer any questions that anyone may have and go from there. But I do appreciate you joining me. And you'll see on the screen too, just a reminder, email me for your $250 certificate to be used toward closing costs. We'll get that out to you. And then my email is jsweat@ihmcloans.com. All right. So, are there any questions? I'll hang on here for just about a minute and feel free to put it in chat if there are. Or if you happen to be watching a recording of this and you have additional questions, feel free to either give me a call or send me an email if you're watching a recording, and I'll be glad to respond and talk to you a little bit more. Okay. All right. Well, I don't think there's any questions. Thank you all so much for being here. And we look forward to working with you in the near future. Take care. Bye bye.